Karen Finerman, I want to begin with you because I know that we've talked a lot in the past about J.P. Morgan Chase. The move in the markets was probably a little disconcerting. But how did you read the move in the bank stocks today?
Well, I mean, clearly it was a painful day for bank stocks. I think, credit is really, to me, the more important factor here, credit and credit quality. And so, I mean, I've been following the high yield index, the investment grade index, and then obviously the banks. I think, we'll hear from them. I guess it's in 2 weeks, but I don't know anymore that price to book is really going to be a metric, or price to earnings, certainly not, because I don't think earnings will be anything significant. I'm concerned about credit quality, and I don't think we'll know. We're not going to know for a while, but it's going to be bad. And so I think we talk about price to book. We don't know what book's going to be, because if the banks have losses, then you're going to be writing down book. So that concerns me. On the flip side, I mean, I think the Fed will do everything that it can to help the banks, who are also helping the Fed. But it was an ugly day. However, I had some other things that were
the 10-year
equally ugly.
Yeah, there was a lot. I mean, we could literally take our pick, Guy Adami, the 10-year at 0.6%. You had the VIX up again, oil down again. What stuck out to you today?
Yeah, not a great day. The banks, and you led with that, I think that's the right place to lead, because, it felt as if the banks found their footing over the last week or so. So today, when you see names down, anywhere from 5 to 7%, it's clearly concerning. And I understand what Karen's saying in terms of price to book, price to tangible book. There's really no way of knowing if they're going to be write-downs. I think the good news, if there is good news, is I don't think these U.S. banks, the main ones at least, the ones we talk about all the time, have the exposure to the energy sector that they may have 5 or 10 years ago. So if there's a silver lining, it might be that. But with that said, what stuck out to me today was exactly that. The fact that the banks really, they lost themselves today, at least for a day. And the fact that the VIX, although, it had been trending low over the last week or so, or the last couple of days, it's back on its horse again. So it's somewhat disconcerting. Yes, Brian.
If you look at the markets overall, you could get, hey, we've seen this playbook before, small caps, retail stocks. So if you look at the IWM, which measures the Russell, if you look at the XRT, which is at least some measure of retail, these were leading us down on the way here. These are the ones that gave out today, along with the banks. And just, people need to hear some bottom-up stuff on companies. And, my view on banks right now, based upon credit quality that we're very concerned about, and reminding that BBB tranche, which is 3 times bigger than high yield, is something that you're expected to see 30 to 40% downgrades on. But Bank of America, which, you could argue could be a proxy for the entire sector, has about a 1.25 loan loss, exposure here. And if you look at the earnings profile of this bank, and if you look at also net interest margins, look, it's no solace that we don't get to normalization until 2022, but that's the reality. And the reality is that right now the bank's balance sheets look very, very strong.
Yeah, Tim, they look strong for now, but when you think about some of the things that Karen brought up in the credit markets, when you think about where the stress is right now, it's in hospitality, it's in energy, it's in transportation, it's in manufacturing. They have a ton of exposure, and they're just basically most exposed to the health of the U.S. and the global economy. So I think, Sully, you just brought it up. You brought up the Russell 2000. I think that is a better lens for getting a sense of what's going on in the U.S. economy right now and the sort of areas that might be in most of need of assistance and then stimulus. So to me, I've heard strategists all day today looking for bottoms, looking for what makes a bottom. And let me just tell you, we've been talking about this a lot. Time is one of the most important inputs to finding a bottom. Make no mistake, financial markets globally have crashed, from equities to credit to commodities. Obviously the dollar has crashed up in a way. It's hovering the Dixie around that 100 level. To me, I just think there's a lot of stresses in the market. There's obviously been unprecedented stimulus efforts, monetary, fiscal, and really until we get this health thing figured out, there is no bottom. There will be no bottom in any of these sorts of markets. So I just think time is one of the most important things that investors really need to get comfortable with right now.
Yeah, and I think the data from LPL Financial was that the average bear market has a bounce of 14%. If you go back to 7 bear markets, going back to 1950. So the action that we saw in the market the last, I don't know, 5 or 7 trading days on that sharp move up, that falls right into historical patterns. Let's go back to the banks. Dan, I want to stick with you. I want to play you a soundbite from James Gorman, the CEO of Morgan Stanley, on in the last hour. He said the dividends need to be saved because people need the income. Let's listen to this, and then, Dan, I want you to comment.
The recipient of the dividends are many times small individuals who own these very large bank stocks all over the country. To lose that income at this time, I happen to think would be a very poor thing to do.
Yeah, Dan, do you agree with that? Keep the dividend?
Yeah, for now, and until they can't pay it anymore, until there's other things that are more important to do than pay a dividend. Obviously, this has been a very important part of investing in financial companies, capital return. It was one of the things that held them back for years and years after the financial crisis. But again, we need to hear those sorts of confident sort of things from the CEOs of these companies, because the worst case scenario would be a lack of confidence, the fear that they're going to cut these dividends, and then investors start selling ahead of it.
Yeah, I tell you what, Brian.
Yeah,
I think
Guy Adami, yep.
Sorry, yeah, Dan was bringing up a good point about the banks here. Ultimately, you don't have financials, which were not giving dividends basically up until about a year and a half ago. They went through their stress test. I don't think Morgan Stanley paying a dividend is like Chevron paying a dividend. That's just my view. But ultimately, banks report in 2 weeks. We're going to get a lot of insight into their balance sheets. We're going to get a lot of insight into credit exposure. I think certainly what I hear Dan saying is there's no reason you have to go out and buy a bank today. And I do think that part of today's move, though, if you look at it on a market basis, was somewhat self-fulfilling. This was the first day of the quarter. The market had rallied massively. There was terrible news on the coronavirus front. And so banks, people are going to go after them. But you don't have to buy them tomorrow. But they're not blowing up tomorrow.
Yeah, and before we get to our guest, Guy Adami, listen, we're all probably talking to people working at banks all day long. I know that I am, both industry contacts as well as just personal friends. And they've launched and they're doing okay, but you wonder the work from home thing, the distancing, how long the banks are going to be able to function, whether it's a commercial bank, an investment bank, if this goes on another couple weeks or maybe a couple months. This is not easy for anyone in any industry.
No, and it's clearly not something that you could prepare for in terms of the duration with which this potentially lasts. So I agree with you, and I understand. Listen, I get what Tim's saying. I understand what Karen and Dan are saying, but it comes down to this. I mean, and this is something I think people should think about. The longer this lasts, you have to ask yourself, with the U.S. economy 73% driven by the consumer, if people learn to live with less, be it by choice or because it's the unfortunate reality, we might be in a whole new paradigm over the next few years. So I think what the market's trying to do, obviously, over these last couple of weeks is try to figure out, what's the real earnings number and what's the right multiple for a market in an environment that's changing beneath our feet.